Welcome to our channel on accounting lessons with worked out problems, brought to you by an experienced accounting professor with a CPA. We have videos on all topics of introductory financial accounting. Our focus is on step-by-step illustration of a problem, worked out on a whiteboard. Each topic also reviews concepts at the end if you need to brush up. Please do not forget to subscribe. This video is on journal entries and ledger accounts. Let us go to the video.
This video will illustrate journal entries, ledger accounts, and trial balances with a problem worked out step by step. Before the illustration, we will review some key points to remember while following the problem being worked out. The problem is described in this video and in the description part of the video. You will find it helpful to have the problem printed on paper or displayed on another screen and reference it while following the steps.
Now, what is a journal entry? A journal entry is a recording of financial transactions in the journal as they happen. Now, what are ledger accounts? Ledger accounts, also called T accounts, are individual record for each specific account. And these ledger accounts show the increases and decreases in a particular account. Now, ledger accounts are important because the account balances for each account are calculated from the ledger accounts, and the correctness of these balances are verified in a trial balance. Now, points to remember when you do the journal entry. Every transaction will increase or decrease one or more accounts. And every entry is a set of minimum 2 entries, at least one debit entry and one credit entry. And every debit must be associated with a credit entry, and every credit entry must be associated with at least one debit entry. But there can be more than one debit entries and or more than one credit entry. Now, which accounts have to be debited and credited and at what time? Asset, expense, dividends. Any account belonging to one of these 3 groups, if they increase, they will be debited. That is, an asset account or an expense account or dividends. If it increases, it will be debited. If that account decreases, it will be credited. Accounts belonging to liabilities, equity, revenue accounts will be credited when they increase and will be debited when they decrease. An account's normal balance is always on the side of the account that shows the increase. Now, let us illustrate a problem on journal entries. Now, here is the problem. The transaction numbers are given and the dates of transaction are given, and there is also a description of each transaction. Now, in the next box, we will see the journal entries. The one in the pink boxes are the descriptions of the transactions, and the entries on the green boxes are the journal entry pertaining to that particular transaction. First transaction happening on January 1st. Here, the owner, Mr. Cosby, is investing $80,000 cash in the company. So this is a direct investment by the owner. So for this, we will debit cash and credit common stock. So this is the debit column and this is the credit column. Cash is an account increasing. Common stock is an equity increasing. So we debit cash and we credit common stock. Next transaction. This is not a transaction, but this is something happening in the company on January 5th. The company hired an assistant for a monthly salary of $2,000. So this is just employing a person, but there is no financial transaction here. Therefore, This does not require any journal entry. Next one, January 8th, company rented office furniture. So here also, the company is entering into a rental agreement with the rental company. But this is not a transaction. So no entry is necessary. Transaction number 4, on January 10th, company borrows $40,000 from a bank at 12% interest. This is a transaction because a company's accounts are affected, cash is coming in, and because the company is borrowing, company also incurs a liability. So here the cash increases and the liability also increases. Therefore, the journal entry will be to debit cash 40,000 and credit notes payable 40,000. Next one, number 5, on January 11th, the company bought a property which includes land and building for a total cost of $80,000 cash. Now, here, the building's cost is $60,000 and the land cost is $20,000. So here we have more than 2 entries. There will be 2 debit entries, 1 credit entry. We debit land, 20,000. We debit building, 60,000. We credit cash, 80,000. As I said, in any entry, the total amount you debit should equal to the total amount you credit. Next, January 12th, company purchased supplies for $2,000 on account. So here the company is not paying the $2,000 now. It's going to pay later. So it incurs a liability. So we debit supplies, 2,000, and credit accounts payable, 2,000. January 15, company provided services to client for $2,000 and received cash immediately. So here the company is providing service, therefore it is earning a revenue and it's receiving the cash for that earning. So here we debit cash, 2,000, credit service revenue, 2,000. January 20, the company provided services to other clients for $5,000 and here the cash will be received next month. That means the customer or the client is going to pay the cash only next month. So this is a receivable, something the company is going to receive in future. So here we debit accounts receivable 5,000, service revenue 5,000. So the revenue has to be recorded because the company has provided the service. The earning process is complete. So service revenue 5,000 credit, accounts receivable debit 5,000. January 23, company purchased 1-year insurance. So here the company is not just paying for the month of January. The company is paying for the entire $1,000 for the entire 1-year insurance, $1,200. So the company is paying for the insurance expense upfront for the entire year. So here we debit prepaid insurance, $1,200, and credit cash, $1,200. This prepaid insurance is an asset. Why is this an asset? Because this prepaid insurance is going to provide coverage, insurance protection for the company for the next 1 year. January 26th, the owner withdrew $1,000 for personal use. So here we debit dividends or withdrawals. If it is a corporation, we call it a dividends. If it's a proprietorship or a partnership, we call it withdrawals. So we debit dividends or withdrawal for 1,000, credit cash 1,000. Last one, on January 31st, company paid 1,000 for the furniture rent, $2,000 salary to an assistant, and $500 for utility. So here also we have more than 1 debit entry. You debit rent expense, 1,000, debit salary expense, 2,000, debit utility expense, 500, and credit cash, 3,500. Again, the total debit should equal total credit. Next we see the ledger accounts. So now, how do we post into the ledger account and what are ledger accounts? So here, ledger accounts, the textbooks also call them as T accounts. The left side of the T account is the debit side and the right side of the T is the credit side. So for the revenues, liabilities and equity, we will enter the increase on the credit side. Therefore, the balance will be calculated and shown on the credit side of these accounts. For assets, expenses and withdrawals, the increases are recorded on the debit side. Therefore, the normal balance for these accounts will be on the debit side. The trial balance is a list of all the account balances from the ledger accounts. So here, you list all the accounts from the ledger, and some will have the balances on the debit side and some will have the balances on the credit side. So you list all these accounts in the trial balance, and then the sum of the debit columns should equal the sum of the credit columns. Here, how do we list the accounts in the trial balance? First, we list all the current assets, and then we list the non-current assets, and then we list current liabilities, and then non-current liabilities. Then come the owner's equity, and then we list the revenues, and then we list all the expenses. Now, we are going to illustrate posting to the ledger accounts in a video. So I'm going to work out the ledger accounts posting on a whiteboard. And then, based on the balances of the ledger accounts, we will prepare the trial balance.
Hello students, in this video we are going to illustrate how to do the T accounts. The answers for journal entries and the trial balance are already included in the video, and in this slide I'm going to illustrate how to enter these transactions in the T accounts. The other name for T accounts, as you know, are ledger accounts. For post transaction on January 1st, I have already drawn some T accounts for you. So for the first transaction, we are going to record cash and common stock. I'm using the abbreviations, folks, because there's not enough space. So cash, we debit $80,000, and common stock, we credit $80,000. Next transactions, January 5, they hired an assistant for a monthly salary of $2,000. This does not require any entry. Again, on January 8, company rented an office furniture. Again, this is not a transaction, there's no entry needed. Next transaction, on January 10, company borrows $40,000 from a bank. Again, we debit cash for $40,000 and we credit note payable $40,000. Debit cash $40,000, credit note payable $40,000. Next one, company bought a property, land and building for a total cost of $80,000. The cost of the building is $60,000 and the land cost is $20,000. So here we debit land for $20,000 and we will debit building for $60,000, and then we credit cash for $80,000. Next transaction, they purchased supplies for $2,000 on account. So here we debit supplies $2,000 and credit account payable $2,000. Next one, company provided service to clients for $2,000 and received cash immediately. So the company is providing service, so it's earning revenue. So you debit cash for 2,000 and credit service revenue for 2,000. And then on January 20, the company also provided the services to other clients for $5,000, which will be received next month. So they are not receiving the cash now, but it's going to receive in the future. So now for this, we will debit accounts receivable 5,000, and since they have already done the service, it's a revenue, therefore you credit revenue for 5,000. And then January 23, they purchased 1 year insurance for 1,200. So here they are paying the insurance premium up front for the entire 1 year. So this will be a prepaid insurance. And this is an asset. So for any expense, if you are paying before they're in court, it goes into an asset. So you debit prepaid insurance for 1,200 and you will credit cash for 1,200. Next one, they withdrew $1,000 for personal use. So this is either called withdrawals or you can call as dividends. So here you can put either withdrawals or another account you can call as dividends. So you debit withdrawals or dividends for 1,000 and you will credit cash for 1,000. Next one, now the company is paying for the furniture rent 1,000, paying the assistant a $2,000 salary and paying $500 for utility. So now what do? You debit rent expense for 1,000, debit salary expense for 2,000 and you will debit utility expense for 500. So total cash they paid out was 1,000 plus 2,000 plus 500, 3,500. You will debit cash, you credit cash for 3,500. Okay, now we have entered all the transactions. Now we calculate every account balance. So for cash, the balance would be $36,300. This is the cash coming in, cash going out. The balance $36,300. And for common stock, the balance 80,000. And for accounts receivable, the balance is 5,000. And for note payable, the balance is 40,000. For service revenue, the balance is 7,000. And for rent expense, the balance is 1,000. For land, the balance is 20,000. For building, the balance is 60,000. Salary expense, the balance is 2,000. And for supplies, the balance is 2,000. For accounts payable, the balance is 2,000. For utility expense, the balance is 500. For prepaid insurance, the balance is 1,200. And for withdrawals or dividends, the balance is 1,000. So now the next step will be to carry all these balances and prepare the trial balance. And the trial balance is also included in this video. If you have it. I hope this helps you to understand.
Now this is a complete set of T accounts which we worked out in the problem. So here you see all the T accounts with the respective balances. And then based on those balances, we prepare the balance, trial balance. So this is the list of this is the trial balance where we have listed all the accounts and with the respective balances on the appropriate debit or the credit. As you see, the sum of all these numbers on the debit side is $129,000, which is equal to the sum of all the numbers on the credit side, which is also equal to $129,000.
In this video, we illustrated the concepts of journal entry and posting them to ledger accounts with a problem worked out, step by step. We used the same problem and showed how a transaction affecting more than 2 accounts would be recorded. We used the same problem to calculate the account balances from the ledger accounts. Finally, we illustrated the preparation of trial balance. We hope we were able to help you with an understanding of journal entries and ledger accounts. Thank you for watching. We have videos on all topics of accounting. Please do not forget to like and subscribe. Hope to see you in our next video.